Good afternoon to those who have arrived so far. We're going to give it a minute or so and let others join the webinar, and then we'll get started. Looks like some people are still joining, so we'll just give it a few more seconds. Okay, well, why don't we get underway? It looks like some people are still coming in, but we have a pretty packed program, so why don't we get it underway? Thanks everyone for attending today's webinar on employment and executive compensation considerations in M&A transactions. I'm Andrew Graw, Chair of our Executive Compensation, Employment and Employee Benefits Practice Group. I'm joined today by my colleagues, Amy Wiwi and Megan Monson, each a partner in the group, Taryn Cannataro, counsel in the group, and Jessica Kriegsfeld, associate in the group. We couldn't be more pleased to bring this to you today. I hope you find it informative and helpful. I'll also mention before we get underway that in addition to the webinars that we do from time to time, we also have a pretty healthy library of podcasts touching on a variety of executive compensation and employee benefit matters, including topics that touch on some of the things that we'll deal with today. So I invite you to check out our podcasts. In the chat, there should be a link to how you can get to the podcast, and we'll also send out additional information later on. So with that, why don't we get underway? I'll be moderating today's webinar, and we'll start with just an overview of the things that we're going to touch on. Next slide, please. So the things that we'll deal with in this webinar are ways in which you can prepare for M&A transactions. Of course, that's mergers and acquisitions. From an employment and executive compensation perspective, we're going to deal with preparation for diligence in a transaction, tools that can be used to retain key employees, and managing the workforce and particularly the knowledge group in advance of a sale. Who should know about the sale and how to manage that. We'll also then deal with certain key issues and focal points during an M&A process that relate to employment and executive compensation. Many of those items are listed here on the slide. For example, key executive compensation and employee liabilities, best practices for treatment of equity in a transaction, earnouts, of course, management rollovers of equity, restrictive covenants, new employment agreements or offer letters for continuing employees, how to treat employees in connection with a transaction, and on the technical side, 280G approval and disclosure where that becomes necessary. Next slide, please. And with that, I'm going to introduce Megan Monson and Amy Wiwi to discuss preparing for an M&A transaction.
Thanks, Andy. And one thing I'll also just mention is, to the extent you have questions throughout, feel free to include those in the chat. We'll also reserve some time for Q&A at the end. So in terms of getting ready for diligence, next slide, please. There are certain documents that a buyer is going to expect a company to have in place. And there are also documents that you're going to typically be required to provide in connection with the diligence process, and also pursuant to any definitive document for the transaction. So we're going to focus on some of those key areas today, in particular ones that could be time intensive to gather, and just points that really buyers seem to dig into.
So with respect to offer letters or employment agreements, buyers typically want to make sure that all of the arrangements are lawful, that you're meeting any wage and hour or other requirements, and we'll talk a little more about these issues when we get into representations, but buyers want to make sure that your employees are properly classified for wage and hour matters. They want to make sure if you have, that you have appropriate covenants in place, that your trade secrets, your client relationships, and other things are adequately protected. They want to see what your policies are and your practices. And, obviously the laws of every state differ on a lot of these matters. And so a buyer is going to want to make sure that you are, paying attention to that, and that you are properly, administering, your documents that, on their face are compliant with state laws.
And on that front, we sometimes see clients that if they know an M&A process is imminent, they may choose to proactively take audits of their records, make sure that they have these agreements in place, make sure that they are compliant with state laws, because it's much easier to get ahead of any potential issues and resolve it before you're actually, in the midst of the M&A process. Another key area is gathering benefits plan documentation. And in particular, if you use a professional employer organization or a PEO, where all of your benefits, 401k plan, health and welfare, all of those benefits are housed and you're receiving from the PEO provider, you're going to typically be required to provide plan documents, summary plan descriptions, and more. And you may not have access to those documents at your fingertip. And so it's important to request that information early on, because it may take time to gather, but it is something that a buyer is going to want to see and will ask about in both the diligence process and, again, maybe required under the definitive documents for the transaction.
There are also, with respect to PEOs, you want to make sure there's a lot of variety in the tasks that a PEO will take on for an employer. And obviously that's based on a contract, but a lot of employers really rely on PEOs to be compliant with, depending on what they manage for you. And there's a wide variety of talent at PEOs. And so you really also want to make sure that any of the, day-to-day employment functions, if you're outsourcing a human, more of the human resources function, that the PEO's employee handbook or documents that they're generating for you on your behalf are in fact compliant. So you can't always rely on the PEO to ensure that your documents look great.
And another item just to touch on in the vein of getting ready for diligence is to consider any off-balance sheet liabilities you may have. I mean, the biggest one that we see are for companies that participate in a multi-employer plan. So if you have a union workforce, you may be contributing to a pension plan that's housed within whatever union your employees are part of. And, there could be a lot of considerations of if the buyer is going to take on that workforce or not. Would that, depending on the structure of the transaction, would that trigger a withdrawal liability, which the cost of which could be significant, or even if it's an asset sale and they are intending to take your workforce, whether they want to assume that liability under what's called a 4204 transfer. So I'm not going to get too far in the weeds on that, but I really just wanted to emphasize that if you do have a union workforce, it is critical to understand if the transaction could trigger a withdrawal from the pension plan and what the cost would be, because that may be, a very gating factor of whether or not to proceed with the transaction. And in terms of severance, just being aware of the severance obligations your employees have, and in particular, for example, if there's ones that could be triggered in connection with termination, in connection with the change of control, there could be somebody has good reason triggers, meaning if there's a change in their compensation or employment for, a variety of different structures, then that would trigger grounds for severance, because those are things you're going to want to think about as you're thinking about what you want the buyer to agree post-closing, because those might be payments that you may be having to otherwise pay out.
On the withdrawal liability, Megan, it's really almost impossible for any company to calculate its own withdrawal liability with any certainty. But it is, there's a procedure built into the statute that allows employers to request an estimate of their withdrawal liability from the fund. And the fund's required to provide that estimate. So it's something to consider seeking before transaction.
Yeah, and that's a great point, Andy, in particular, because that can take a little bit of time to get that from the fund. It's part of the, I'll say, proactive planning of things to kind of get all your ducks in a row in advance. Next slide, please.
Oh, so here are some of the issues we started talking about earlier. So worker classification comes up a lot in connection with transactions. Sometimes folks are, these are, independent contractors, typically, they're vendors, but there are a lot of companies who use independent contractors, use individuals as independent contractors. And interestingly, the test, and like everything else, right, the test for whether a worker is an independent contractor or an employee varies significantly by state law. And this kind of thing usually comes up in connection with an application for unemployment insurance. So if folks are going to be separated, you want to make sure that you have the seller, that you have that under control. As far as the classification as exempt or non-exempt under the Fair Labor Standards Act, or applicable state law, that, that can be problematic. And sometimes, you need to properly, change classifications before, or, think about that, because those are some, wage and hour liabilities can be significant, and they carry with them, sometimes triple damages and employee, attorney's fees and those sorts of things. So, that's something you want to think about. As far as authorization of the employees to work in the United States, you want to make sure there are I-9s and all of that, but you should take a quick look at any of your employees who are in the US and authorized to work by reason of a visa, right? They have a work visa, just to ensure that nothing in the, depending on the structure of the transaction, you could, somehow someone could lose their eligibility. And this has happened before, where, the CEO has some kind of special visa that is, contingent upon the parent company being located in a particular jurisdiction. And, the buyer comes in and is not of that same jurisdiction. So it can be really impactful.
And I think a lot of the goals, really, from all the things that Amy's mentioning so far, is there's going to be a purchase agreement or a merger agreement that's going to set forth all sorts of representations the company's going to have to make in terms of the employee benefits and executive compensation space. And in order to be able to make those representations or determine if you need to disclose against them, Amy's really trying to focus on, we'll say, some of the key areas of consideration where we see companies potentially have issues. So again, being proactive up front and reviewing these items can help you not only, one, determine, because you are going to be expected to make representations about these matters, if you can make them, and if not, whether there's anything that could be done proactively in advance of a transaction to resolve any issues.
Yes. And I think we will talk about the WARN Act a little bit later, but you know, if there will be an employment loss at, you know, a particular site or plant closing, as these things are defined in these various statutes, there can be a lot of variation in the state laws. So for instance, you know, under certain circumstances, the New Jersey Mini Warren Act requires certain amounts of severance to be paid to folks who are separated, whether or not you give them the appropriate notice. And, you know, California has some weird provisions about plant closings that, you know, could be in play with only a few employees who might be affected. So, you know, these are the kinds of things you want to think about in connection with a transaction, whether these would come up. Yeah,
Like,
payroll.
yeah, so then the last thing I think I'll mention kind of in this topic, we'll get into this in a little bit more detail in terms of who needs to be in the know, but right, getting ready for some of these representations may require consulting with people in HR, gathering various documents. And so considering kind of how to approach that and when the right time is to do so, because again, these I view as all part of the M&A preparation process. Next slide, please.
I'm Taryn Cannataro. As Andy said, I'm counsel in the Employment Executive Compensation Employee Benefits Group. And I'm going to talk to you today about one area of diligence that usually buyers spend a significant amount of time and attention on, which is managing your cap table and your equity plan and award agreements. One item that you want to make sure that you get started on as early as possible is just making sure your equity plan, award agreements, and ancillary documents are in good order. And in addition to the plan documents themselves, you want to make sure you also have the resolutions approving the plan documents, resolutions approving the awards granted under the plans. That's an item that the buyer is definitely going to look for and you're going to have to disclose. Another item is just considering the flexibility you have under the change in control provision of your own plan. So some change in control provisions are very broad and allow you to do whatever you need to do to effectuate the treatment of the options in connection with the deal. Some could require advance notice to option holders, giving them the chance to exercise. Sometimes plans require assumption of awards. So you just want to make sure you have a full understanding of what your plan provides. Relatedly, you want to make sure you understand any accelerated vesting in the plan or award agreements that could be implicated. So some plans could provide single trigger acceleration where anything that's unvested vests in full upon the change in control. Sometimes that's double trigger where the acceleration only occurs if there's a termination or maybe resignation for good reason. So just understanding what the awards actually provide. You also want to consider how the parties intend to treat the outstanding equity awards and whether the treatment is permitted under the plan. So a lot of times that's just a conversation with the buyer and making sure that you're all on the same page and that your plan allows what is being requested. You also want to consider whether your plan allows you to require award holders to sign cancellation agreements, releases, or other agreements that may be requested by the buyer. Sometimes this is expressly provided in the plan that they have to sign these agreements to get payment from the awards. Sometimes you need participant consent to do it and you can't do this unilaterally. So again, just understanding upfront what's going to be required to effectuate the treatment that you're considering in connection with the deal.
And of course, if you're asking for cancellation of an equity award, it usually requires some consideration be paid to the holder of that award.
Exactly. And in order to do this, a lot of times the first step is just making sure that you have an accurate cap table. So just having a full understanding of what awards are outstanding under your equity plans, what's vested, what's unvested, and just getting an idea of the universe of what you're going to need to deal with in connection with the deal.
And I think that's actually one of the areas that I see from a buy side focused on, say, most intently, because it really is important to know who's going to be involved in signing on to the transaction. And so this is another area where sometimes companies may be proactive in whether they have a sale expected on the horizon or whether they just have a lot of cap tables, you know, periodically reviewing their documentation and cap tables to make sure everything lines up.
I agree. And I think conversely, it's also an area I see where a lot of sellers have last minute scramble because, if they don't have a good idea of what's out there, it's something that the last minute you have to figure out. Another area that buyers will focus on is just ensuring that all awards received board approval and all options have an exercise price no less than fair market value as of the date of grant. And in merger and stock deals, buyers typically want reps that options were validly granted and that the exercise price was no less than the fair market value as of the date of grant. So to the extent you don't have board approval or something could have been granted with a fair market value or with an exercise price less than fair market value, something you just want to get ahead of sooner rather than later.
Yeah, that can be a real source of angst when you see that representation in a deal document and sort of scrambling because there aren't board resolutions that document the option, or if there's not even an option grant agreement evidencing the grant, and then trying to trace back how the fair market value or exercise price of the stock was determined at the time. A real source of angst.
And I think it can often be cleaned up a little bit easier, right? If it's discovered in quote unquote real time or not on the eve of a transaction, when you can be a little bit more thoughtful, dig through the documents and see if there's a way that it could be resolved in advance of it being a highly scrutinized issue, potentially holding up a deal.
Yeah, it's so much easier to remedy that kind of situation without a buyer looking over your shoulder.
And then a few other areas that you want to pay attention to are whether any options could be expiring, and if so, what you want to do about that. Whether options are in the money or underwater. A lot of times, equity plans allow for you to cancel underwater options without consideration, but it's just something that you want to be aware of because it could be an area that's notable for the option holders if their options are being canceled because they're underwater. And also you want to confirm whether 83B elections were made with respect to restricted stock awards, because that can affect the tax timing of the treatment of some of these awards. Next slide, please.
So another topic that we've started to allude to is how to manage the workforce and knowledge group. We've touched on a couple of different things, such as gathering information, making representations. And so when you're thinking about who needs to know about the transaction and when, I think some of the key questions are, one, who's going to be the decision makers in the transaction, right? Whether it's key shareholders, in addition to their, people in the C-suite typically are involved in negotiating certain provisions of the deal documents. They also may be the folks involved in trying to gather the information that's needed, and particularly on the cap table financial side of things, some of the employment and benefits related documents. And so those people I would expect to be kind of in the knowledge group initially, because they really are going to be driving the deal process. In terms of disseminating that information more widely in terms of other employees, I think it's always, you have to be careful of thinking about whether the deal is going to be exciting to the employees or not, and what the circumstances of the deal are. For example, if it's a fire sale, the company looks like it's going to be going out of business, this is a way to save it. That could be a way that, employees may be excited about it. Also, if the company has been doing really well, employees, and there's a lot of option holders who will get payouts in the deal. Again, they'll typically be excited about the deal prospect, but you kind of have to think about how that's going to be perceived by your workforce when you're deciding how to advise the employees of the transaction. And often, unless there's folks that need to be in the know for various reasons to help with these aspects of things, most employees aren't going to be finding out about the transaction until after it's already occurred.
I agree. I think that keeping the group small as you can, is a good idea, because folks will panic. Maybe people will leave, and you're not delivering, sort of the workforce that the buyer expected. Yeah, and I think it's all in the communication as well. So plan for some leaks, right? People hear things at the water cooler, but but yeah, you have to be careful about how folks might react to it.
Right. And again, I think it's ways to get people excited. Again, as I mentioned, if, there's a transaction, the company's doing well, and you need to bring other people in the tent, some companies might be giving them change of control bonuses or other things, which we'll get into in a minute, of ways to compensate them for helping with the deal process. And if people have money on the line, they're going to inevitably get excited about it.
Is
Next.
is there an opportunity there for perhaps some white lies? To, be able to gather diligence without giving away the secret. Like maybe the documents are needed for a bank loan or something like that.
Yeah, and I think that's a great point, Andy. So I do think, especially on the benefit side of things, it is a little bit easier to say that we may need this information for audit or reviewing our information, or there can be other reasons to give people if you need people to help gather the information without bringing them into the fold. Next slide, please.
So we're going to switch gears now and talk about some retention tools. As Megan referred to earlier, you might want to help incentivize your employees to stay on through a change of control and help make them feel like they're excited about the deal. And there are a few ways to do that. One of the ways is to adopt what is called a management carve-out plan. And this type of plan, it's typically a cash bonus, and it carves out a portion of the sale proceeds to pay certain key individuals to motivate them to stay with the company through the transaction. And usually those proceeds are off the top before other equity holders are paid. So to the extent that somebody holds equity awards that may not be that lucrative in connection with the deal, then this gives them an opportunity to make a little bit of money in connection with the deal and help stay on to be part of the deal team and push the deal forward. It could be a kicker for individuals who hold equity, or a way to incentivize those whose equity could be underwater. And the great thing about these type of plans is that they have significant flexibility. So you can give participants a fixed amount of the deal proceeds, or you can allocate funds to a bonus pool where participants can either receive a fixed sum from the pool or a percentage of the pool in exchange for their continued employment. And you could choose to offset payment from this plan by the amount of equity proceeds that the person receives to avoid double dipping. You also could tie a portion of the payments to contingent proceeds in the event that the deal has a significant portion of the proceeds will be contingent. You can tie a portion of their payment to the contingent proceeds where they would pay out similarly at the same time as other stockholders. And you can also consider conditioning payment on a release. So to the extent that you don't have another opportunity to get releases from these individuals, this is a good opportunity to do so in exchange for them getting a little bit more money in connection with the deal. Another function of these plans is that it often gives you another ability to couple this with restrictive covenants and get confidentiality and non-compete obligations from people who don't already have those in place.
And if they don't, you really probably want folks to have those, especially in connection with the deal. And folks are really willing to agree to to agree to these types of things in exchange for a cash payment. So I think that is an area where a seller could really clean things up a bit while conducting the transaction.
There are a few legal considerations to keep in mind if you plan to adopt this type of plan. For example, it has to be structured to comply with or be exempt from Section 409A. And Section 409A is a complex provision of the tax code that taxes non-qualified deferred compensation. And if you're within the realm of 409A, there are a number of restrictions and procedures that you have to follow with respect to payment of this compensation. A lot of times we try to structure these plans to be exempt from 409A, but coordination on this or figuring this out requires coordination with benefits counsel often to make sure that it's done correctly. Also, payments from these types of plans could be potential parachute payments under Section 280G, which is something that we'll talk about a little bit later in this transaction.
We will touch on that later. We also have a significant amount of information out there from other webinars and also in our podcasts about Section 409A and 280G. So anyone who's really interested in a deeper dive on those areas can look into those previous communications on those subjects. Next slide.
I'm Jessica Kriegsfeld, and as Andy mentioned, I'm an associate in Lowenstein's Employee Benefits and Executive Compensation Group. So retention bonuses are often given to employees as a financial incentive to keep employees with the company, like through a merger or restructuring. Sellers might offer their employees a retention bonus as a way to compensate them for extra work associated with the transaction. And buyers might offer a retention bonus as a way to incentivize employees to stay with the company post-closing. So retention bonuses are often contingent on the employee remaining employed for a certain period of time or upon the achievement of a certain milestone for the company. Retention bonuses can be structured in a number of ways to fit the needs of the deal. For example, the bonuses could be paid in a one-time lump sum payment. It could be paid in installments over time, or it could be subject to a holdback, requiring the employee to remain employed for a period of time following the closing of the transaction. While retention bonuses are typically paid in cash, they can also be granted as equity awards. As Taryn mentioned about management carve-out plans, retention bonuses must be structured to comply with or be exempt from Section 409A, and they could be considered potential parachute payments for disqualified individuals for Section 280G purposes that we'll touch on a little later.
And similarly, as Taryn mentioned, I think they can, again, be coupled with restrictive covenants, which would include confidentiality, assignment of IP, non-solicits, non-compete obligations. And something that we've been seeing more frequently is this may be used essentially as a tool to quote unquote lock somebody up for a longer period of time post-closing. And in effect, while you can't have a longer duration non-compete if it runs during employment and for at least a year thereafter, if you have people getting payments for a period of time post-closing because there's always money on the table, it's more likely that they'll stick around and then less likely that they're going to be competing with the business shortly after closing because they have the financial incentive to stay there. And that could be a good creative tool to use, in particular if you're in an industry where the employees are the business and you're trying to think of ways to really get people to stay around because their departure could be harmful. Next slide.
Okay, so now we're going to shift into some particular issues and topics in connection with an M&A process. With that, I think we'll kick off the next slide, please, with Megan and Amy again.
Great. And before getting into this new topic, I'm going to read the first CLE code. It is 516281. Again, it's 516281, and it will also be available in the chat. So, kind of shifting gears a little bit till when you actually now have an M&A deal that's being negotiated, there's a number of different considerations that you're going to want to think about. In terms of executive compensation and employee liabilities, one of the first things that we see companies asking about is what payments are going to be owed in connection with the transaction. So are there change of control bonuses? Is there severance going to be triggered? Are people getting paid with respect to equity awards? Are all, what are the terms of those arrangements? If there is any potential withdrawal liability, as we talked about earlier, that could have a significant impact of the deal. So these are all really things that could impact both the cost and how much the buyer is going to be paying for the transaction if there's withdrawal liability, but also from a sell side, what are the shareholders going to take home? And are there some of these different liabilities that are going to be having to take off before shareholders receive payment? So just having a baseline understanding of what's out there in the universe of what your employees have and who's going to be getting payments is important. And that also may be opportunities to, you know, as Taryn mentioned in the management carve-out plan, right, get releases of claims from people if they're getting change of control bonuses or severance, or if their equity awards allow for that. So just thinking about kind of all of those implications.
One other benefit to understanding this stuff ahead of time is these are items that you're probably going to have to, if you're a seller, disclose on your disclosure schedules and share with the buyer. So just knowing ahead of time what could pay out in connection with the transaction could be helpful.
With respect to the WARN Act, this is something that you should be thinking about well in advance of any kind of closing, because the WARN Act requires, under certain circumstances, that you provide notice to employee if your situation will fall under WARN. It's notice to individuals, and other than New Jersey, which may require severance payments to individuals, even if you provide the requisite notice. Failing to comply with WARN is can be problematic, because you would owe those folks, if you are late providing notice, you owe them all of their compensation and benefits for the period that you were late. And it's not the type of claim that can be waived, right? So it's hard to get a release in exchange for payments for failing to provide the requisite notice. You also need to, not only notify the employees, in a lot, you have to notify the location, the state, the town, and certain other designated individuals. As I mentioned earlier, a lot of states have some tricky provisions that differ from the federal WARN Act, as far as, who is considered, how many employees are affected, the plant, whether a, closing of a particular site is a plant closing. And, it can get very tricky. So you need to plan ahead so that individuals are provided the requisite notice, and the appropriate, government entities and agencies are provided with that notice as well. And that's public information. So if you're providing WARN notices to folks and filing them with, municipalities and other things, that information is publicly available. There are, this is sort of an online world. So it is not, and there are folks who are trolling, there are plaintiffs' lawyers trolling, looking for these WARN notices to see if they can find some fault in what a company has done. So this is important if there could be, plant closings or any kind of layoff that affects a good number of folks.
Yeah, and on that point, there could be covenants in the purchase agreement or merger agreement that allocates liability with respect to WARN. And so, again, it's just something, as Amy said, to be aware of in advanced planning. If there are potentially going to be either layoffs in connection with the transaction, whether it's, done by the seller or the buyer, and who's going to be responsible for furnishing those notices and the costs. Another thing that's relevant in terms of allocating liabilities is the structure of a transaction. For a stock deal or a merger, you're essentially going to step into the shoes of the seller. And so you're going to be responsible for any outstanding liabilities and, any outstanding plans. Those will be yours going forward. Versus in an asset deal, you have the ability, absent areas where there could be successor liability, which I'll touch on in a minute, to really negotiate and leave behind a lot of liabilities. And often we see in asset deals, typically employment liabilities that precede the closing period remain with the seller, again, absent successor liability items. And we often also see benefit plans and related liabilities remain behind with the seller, to the extent the buyer has an entity, whether it's a PE company that has a portfolio company already in place, or just an existing company that's running that already has their own benefit plans in place, then often they will leave benefit plans behind as well. Even in an asset deal, if your deal document still says you're leaving behind all of these liabilities, there still are certain situations where successor liability could ensue to a buyer, notwithstanding what the deal document says. And a couple of key areas in there to highlight are, if there's a defined benefit pension plan, a multi-employer or multiple employer plan liabilities, if there's a union workforce, unreimbursed violations of certain employment laws, or failure to contribute to ERISA plans. Those are some key areas to focus on, that even if you aren't an asset deal and you think you're safe from inheriting any historic liabilities, those are still areas you want to be focused of and concerned about, because the successor liability rules could apply for you there. And on the buyer side, just some ways that you could think about in terms of limiting your liability, both in an asset and a stock deal, just in terms of what's going to be, your cost to bear going forward, is having fulsome representations and having as a backstop, if there is a breach of those representations, either a rep and warranty insurance policy or an indemnity. And so in the use of a rep and warranty insurance policy, if there's fulsome reps and there was a breach of those reps, you would have recourse against the policy to be kind of quote unquote made whole to the extent of policy limits for those breaches of representations. Or similarly, on the indemnity aspect, the seller would be required to indemnify you if you have a specific indemnity. And sometimes there will be money held back from the deal in an escrow for a specific area of concern until the statute of limitations for that issue expires. Next slide, please.
We could have a whole presentation about Section 280G, but I'm just going to highlight a few 280G related considerations in the context of a transaction. At a high level, Section 280G is intended to discourage excessive compensation, sometimes referred to as golden parachute payments, to certain disqualified individuals, including officers, highly compensated individuals, and greater than 1% shareholders of a corporation undergoing a change in control. There are certain compensatory payments that will be considered in a Section 280G analysis. Some common payments includable in the analysis are transaction bonuses, severance entitlements, even if the employee is not being terminated, accelerated vesting, any increases in compensation in the past 12 months, and more. To assess if the parachute payments are going to trigger a Section 280G issue, there's a special formula that, in a nutshell, looks at 3 times of the potentially disqualified individual's historical average compensation over the past 5 years. If there is a Section 280G issue, there could be a 20% excise tax on the excess parachute payments for the individual and a loss of a tax deduction for the company. Private companies have the opportunity to conduct a shareholder vote to cleanse these payments, and we'll discuss that more on the next slide.
Yeah, no, I just add, Jessica, that, in a deal document, it's pretty standard to have a statement that there are no payments that would trigger 280G. So, usually in a transaction, we'll do a fairly complicated analysis of a company's possible 280G payments to see whether or not there's anyone who could trigger 280G.
If a company knows that it's going to undergo a transaction, there's some planning opportunities. And planning opportunities are especially important for public companies who are not eligible to do the 280G cleansing vote. So for example, some planning opportunities, a company could think about 280G thresholds for potentially disqualified individuals. A company can consider 280G cutbacks. There are different types of cutbacks, but the idea is the company can reduce payments to a level that doesn't cause the individual to trigger 280G. And this can be added, the cutbacks can be added anywhere that the company is offering compensation, including employment agreements, retention bonus agreements, or management incentive plans that we talked about.
And on the planning opportunity for public companies, one thing you can also think about is getting a valuation for a non-compete to the extent it is a state that allows for non-competes, because that can be used to offset the amounts of the potential parachute payments. And that is also something that can take time to do. So if you are a public company and expect a transaction, that's something you can think about doing in advance.
And as well, if you think a transaction is going to be coming up, there are things you can do in a year prior to the year of the transaction in order to try to either limit the exposure to 280G or completely eliminate it by For example, accelerating vesting to an earlier period of time, paying out compensation that would have otherwise been paid in the future. Have to be careful about doing that because some of those things are themselves parachute payments. But if done early enough, they can really reduce the impact of 280G.
Next slide, please. As we mentioned, private companies, not public companies, have the opportunity to cleanse 280G payments with a shareholder vote. This would allow the disqualified individual to avoid the 20% excise tax and prevent the company from losing a deduction. The shareholder vote would require the approval of more than 75% of the disinterested shareholders, meaning the disqualified individual, even if a shareholder, can't vote. The shareholder vote is often included as a requirement or a covenant in the purchase agreement. At a very high level, to conduct the 280G vote, first, all disqualified individuals must sign a waiver that essentially waives their right to receive any excess parachute payments if the vote doesn't pass. And once all the disqualified individuals have executed this waiver, then the company will provide a disclosure of all the potential parachute payments to the shareholders. And the shareholders, the disinterested ones, will vote on the payments. Next slide.
Turning back to talk about equity for a little bit, as I mentioned earlier, there are different ways that you can treat equity in connection with the deal, and it will depend on the terms of the underlying equity incentive plan, but also the type of M&A transaction that you're undergoing. Some of the potential and often common treatments of equity that we see are a cash out of vested equity. And that means either a cash payment or other non-cash considerations such as buyer stock in exchange for cancellation of the award. And that payment is usually based on the deal consideration they would have received had they been shareholders and, for example, exercise their options. Another treatment that we often see is the cancellation of underwater or unvested options without consideration. You could also cancel unexercised options, and this is a good opportunity for what we talked about earlier, having an option cancellation agreement with a release. And usually in connection with the cash out and cancellation of the options, you can ask option holders to just sign this agreement, agreeing to the treatment, agreeing to the payments they're receiving, and it's a good opportunity to get a release in connection with the payment. You also want to keep in mind any accelerated vesting that could be triggered as a result of the transaction. And this sometimes includes determining achievement of performance-based vesting to the extent that you have unvested awards that are based on performance targets. And sometimes the deal itself could be achievement of the performance target, causing an award to vest. Another way you could treat the equity awards is having the buyer assume or substitute the awards. And usually that has to be done with careful consideration to make sure that you're not running afoul of the rules under the tax code for assumption. And one other point to mention is that there are 280G issues that could come up with respect to how you treat the equity. For example, any acceleration of equity would have a 280G value, and any new equity awards granted within the past 12 months would have a 280G value as well. Next slide, please.
We've talked periodically throughout this about earnouts. Earnouts are essentially forms of deferred payment to a seller or seller shareholders that are contingent on achievement of post-closing milestones. Effectively, a buyer wants to make sure that the company performs as has been represented and will essentially hold back part of the purchase price and make it contingent on achievement of those milestones and earnout. Earnouts are typical in mid-market deals. We've also seen them in a number of public deals as well, public company deals. Delaying part of the purchase price incentivizes the sellers to remain involved in the business since their financial interests are tied to the business performance. It also means that the seller will want key employees who are integral to making sure that the company can achieve an earnout will remain with the company after the closing. And that harks back to some of the things that we talked about earlier, like a management carve-out plan or retention bonuses, severance protection, things like that. Earnouts can also impact existing arrangements that employees have. For example, a number of companies have phantom stock arrangements. How a phantom stock arrangement values phantom stock is extremely important when there's an earnout. How is that earnout going to be taken into account in determining the value of that phantom stock? And will the phantom stock be paid in one lump sum at the closing, or will it be paid out over time as the earnout is achieved? All of those things are important considerations when developing those arrangements. If they're not already addressed in those arrangements, then it's really important to see whether or not some modifications to those arrangements can be made in order to accommodate an earnout, should there be one in a transaction. And then it also affects stock option exercise prices. If stock options are being assumed in a transaction, there's typically a need to adjust the number of shares subject to the option, as well as the exercise price, to take into account the price of the deal. When there's an earnout, it can be extremely difficult to determine how that earnout can or should be taken into account in adjusting the exercise price of the option going forward. Next slide.
So I think similar to the earnout idea, we've been seeing an increasingly popular practice of management rollover of existing equity, whether it's just shareholders or we'll say key members of management. And sometimes they're given the opportunity to roll over their equity. Sometimes they're actually being required to as part of the transaction structure and as a requirement from the buyer to roll their equity into the buyer's entity. And depending upon what the structure of their prior equity is, what the terms of their new go forward equity is, there could be 280G considerations at play there as well. So that's also something to think about. And, really from a buyer standpoint, this helps continue to incentivize key employees to stay on with the business. They have less cash outlay up front. It could delay some tax implications, but on the flip side, the individuals who are rolling their money over are receiving less compensation up front. They're taking a risk of there could be a decrease in value, their equity being diluted. And the equity may cut into post-closing profits depending upon when the post-closing entity is sold. Next slide, please. So this next topic is something that we could probably put a whole CLE on about, but we're going to just try to touch on a few high-level considerations in terms of restrictive covenants, both from a sell side and the distinction between employment-related covenants. So typically M&A deals, whatever the structure, stock, asset, merger, they're going to have restrictive covenants in the purchase agreement that would bind sellers and prevent them from, amongst other things, essentially establishing a business in competition with the post-closing entity's business, poaching key staff, and poaching or contacting customers or prospective clients. I will say one thing to be aware of is in the past, the courts have been typically deferring to sellers about the scope of these covenants. Within the past couple of years, in particular Delaware, which Delaware law governs a lot of purchase agreements, they've become more strictly scrutinizing deal-related non-competes. And so to tread carefully and really ensure that the deal-related non-competes are carefully tailored and tied to the business that's actually being purchased, in terms of trying to increase enforceability, because some courts have also not been blue penciling these covenants, which is essentially reforming them to be enforceable and been validating these non-competes outright. And because these are so critical to a transaction, it is important to make sure that these are drafted in a way that is intended to be compliant with applicable law. As I mentioned, these are going to be contained in the deal document. Typically, they're going to run from a period of time post-closing, often 3 to 5 years post-closing. You may also have employment-related covenants in an employment agreement that run during employment and for a period of time thereafter. And it's important to the extent that you have a seller who's involved in the transaction that can sign up to the deal documents, but also is going to be a key employee going forward, to have them bound by both, because depending upon how long they stick around, the employment non-compete may run longer than the deal non-compete. And, there are the different considerations in terms of duration, geographic scope, and restricted area. So it's just important to think about kind of all of these considerations. And we often may see, again, having key employees sign up to new employment agreements or new covenants agreements as a closing deliverable, if they, again, are really critical to the business and their competition could be harmful to the business being purchased.
I agree. And I mean, there are some cases in certain states that that will invalidate a transaction covenant if it is tied to employment in any way. So you want to avoid that your transaction covenants running from the, during employment and for a period of time thereafter. Because even in states that disfavor these in the employment that disfavor them in the employment context, to have some exceptions for sale of business, you just have to be careful about, how you draft them, and that these are two very separate concepts.
Yeah, and I think just also going back to making sure they're enforceable from a state law perspective. So whatever document both is governing the transaction based upon where the seller entity is based, and also from the employment perspective where the individuals are going to be working. Next slide, please. So another thing to think about in terms of kind of the concept of transaction and also post-closing is whether to require a number of seller employees to accept employment as a closing condition. That's something that we've been seeing kind of an increasingly popular practice over the past couple of years. And as I mentioned, having key employees sign new offer letters or employment agreements or covenants agreements as a closing deliverable in the transaction. The context of the deal the structure of the deal may also be relevant. So in asset sales, there would be a termination as a matter of law. So buyer typically has the option to choose which employees they want to hire and will do so on their forms, versus in the stock deal, they're going to just continue. There's no change of employment. So they'll continue with the buyer, and buyer will assume those liabilities, but they may want people to enter into new arrangements for a variety of reasons. If they're changing their comp structure, if they don't have good documentation initially. So there might be an opportunity to do so, although consider state-specific laws if you are requiring them to enter into new agreements, to make sure that if any additional consideration is needed, that is provided. And just as a general matter, whether to have employees sign offer letters or employment agreements, typically a rule of thumb is offer letters are used for rank and file employees. But if you have a senior executive or higher level employees that have more complex compensation structures, employment agreements may be appropriate there.
Yeah, and I just one point I want to make about requiring sellers' employees to accept employment or a certain percentage. I mean, that could happen. And I mean, if these are at-will employees, I mean, there's no way to tie people up for a period of time. It has to be, voluntary, obviously. So you want to use all of these incentives that we've discussed earlier to entice folks to come and to entice them to stay.
No, you're exactly right, Amy. And that sometimes becomes a risk of, for the transaction, and figuring out different ways you can incentivize them to come across so that you can meet those, deal level requirements. Next slide, please. So just to quickly tick through the last topic in terms of treatment of employees, the purchase agreement may include, whether it's buy or sell side, think about whether you want to have compensation and benefits continue for typically a year post-closing, no favorable than compensation or benefits as received pre-closing. Again, that's a negotiated term, but that's something that's we often see. Similarly, crediting of service with respect to participation in buyer benefit plans is something that's common in a transaction agreement. And for the year of transaction, if benefits are changing, crediting co-payments and deductibles is something that, again, is typical, especially asked for on the sell side, because employees do care about if things are changing and how their benefits compare to what they've had before. And so, especially if you're getting later in the year, that crediting of co-payments or deductibles can be important. Or, kind of the converse of what we talked about earlier, of bringing people into the tent early on, it's also important to think about how to communicate new terms of employment at the time of a transaction and post-closing.
Yeah.
In particular, right, you're having a new buyer step into the shoes, whether it's an asset sale and, you know, now they're coming on as your employee, or still in this stock deal, you're stepping into the shoes of the old company. You may be making changes to different aspects of their compensation. You may be making changes to the organization. And so it's really important to think about how and when to communicate any new terms to people, because again, I think the idea is, even if changes are being made, you want people to be excited about this new opportunity. You want to focus on, even if things are changing, maybe they're changing for the better, but it really all comes down to the messaging and how that's portrayed and being kind of as clear as you can with the employees, because it's often their first interaction with a buyer.
Yeah. The other thing that you may want to think about is just taking from a pay, there are all of these new pay equity laws, and ensuring that the folks who are coming on are being paid, you know, commensurate to those existing employees. If they're performing the same job, obviously, you know, that can be something you don't need to worry about, but you want to make sure that folks don't come on and realize that, you know, the buyers' existing employees are making significantly more money. That can lead to other problems. And so you want to ensure that there's some equity, you know, between and among existing and new employees based on the transaction.
I say that it's at 1 o'clock, so I want to be mindful of everyone's time. Megan, could you give everyone the second CLE code, please?
Yes, it's 507030. Again, 507030.
Okay, and we'll stay on for a minute in case there's any questions that anyone wants to ask. But on behalf of everybody, we really want to thank everyone who's attended. There's a lot of detail to this topic, and we probably could have spent another hour or so going through each of these issues in a little bit more detail. But as I indicated earlier, we do have detail on some of these subjects in other webinars that can be accessed, as well as podcasts. We're always available as well in case anyone has any questions or needs. So feel free to reach out to us if we can be of assistance. Thanks so much for attending.
Thanks, everyone.